Is TLT a buy here at these current levels? Hi everybody, this is Mike Rixey. I'm the lead options instructor for NetPicks. And in this video, I want to walk you through how I prepare to put on a new bullish trade. I'll walk you through what I'm looking at on the charts. I'll jump over to the trade page, walk you through how I'm going to structure the trade with a call option and how I can put that trade on that's going to give me the most profit potential while limiting my risk as much as possible. So let's jump in. This is a 130-minute time frame on TLT. This is the bond ETF that we like to look at. I get it. Everybody loves to trade the high-flying tech stocks. I do as well. But I also want to make sure I have a diversified approach. I want a mix of markets, individual stocks, ETFs, different price points, different sectors. The more layers of diversification that you can put into your trading, the better off your consistency will be over time. And that's what we're all looking for. Right? We're all looking for those consistent gains in a wide range of market conditions. Now, if I take a look at this chart, notice I have my blue dots on the chart. The first issue that I see facing a lot of retail traders right now is not having that system in place. You don't have a rule set that's guiding you on every decision that you make. When you start to see volatility pick up and you start to see markets trade all over the map, really important to have a rule set there that's guiding every decision that you make, both entering and exiting a position. Now, the point of this video is not to go into the details of what we're looking at here in this setup. The goal of this video is to walk you through how we take it from setup to an actual option position. What I'm looking at here on this blue setup, I have an exact entry point. I have my two targets above and I have my stop below. I can't stress how important this is. You want to have a plan in place because if you don't, you're going to be left overreacting to every move back and forth. The minute the trade goes in your favor, you're going to want to close it out. The minute the trade goes against you, you don't want to lose money, you're going to close it out. Because I have a roadmap in place, now I know exactly where to get in, where to get out before I ever put the position on. Right? So my bullish trade is right here. My entry point is at 90.07. You can see we have not seen price touch that entry point yet. I know it's there, but my last step is I need to see price come up and touch that level. If it does, that's when I go ahead and enter the position. But I see that it's a potential setup. Now I can go over to the trade page and start to get the trade ready to go. So let's do that right now. Let's go over to the trade page on TLT. And here's the second big mistake that I see retail traders making is they put positions on that don't necessarily match up with their outlook. And what I mean by that is they might take a big macro view, what they expect the market to do 6 months from now, and then they go put a position on with a weekly option. Right? Well, that doesn't necessarily match up. That weekly option is very time sensitive. You need to move immediately, whereas the research that you put into that trade is looking out 6 months. It doesn't match up. What I'm looking for when I took a look at that 130-minute chart of TLT, my expectation is for a swing trade. For my swing trades, I typically like to go to the options that have around 40 days left to expiration. That way, I can get the position on. The time decay is not as significant. Right? The time decay would be way more significant if I just go with a weekly option, right? So by going out further in time, it gives me more time for my directional outlook to play out without that time decay becoming such an issue. And for that means I'm going to go out to the December monthly options with 42 days left. Could you use a weekly? You could. Here's the problem with that. Here's what I see so many traders doing. They have a trade on their charts. They're going to go out to a weekly option with 7 days left to expiration. And they're going to go deep out of the money. Right? We were looking for a bullish trade, right? So a lot of traders will go out to the 91 calls, for example. Right? They're very cheap. They're trading for 15 cents. They're looking for a cheap bet. People do that. You take a look at any area of life, everybody's looking for the cheap bet with the large payoff, right? You go buy a lotto ticket. You take a look at sports gambling. Everybody goes for the 5, 6, 7 leg parlay that has a very low probability of success, but they look at it and say, hey, that's a cheap bet. If it hits, I win big. As a trader, you've got to transition your mindset away from that approach and saying, okay, what can I do to put on a trade that's going to give me a high probability of success, where I can start to stack winners on top of each other? I don't need everything to line up perfectly. If it does, yes, there's a payoff there, but it doesn't happen often enough, right? You're going to be frustrated more with that approach because you do need perfection. What I want is a more forgiving trade. So for that, let's go back out to the monthly cycle. Let's go out to the 42-day options right here. Remember, our entry point is just over 90. So if I go to the 90 strike, that's my at the money call option. Ideally, I want to go slightly in the money. If I go up to the 89 call, it's going to be a little bit more expensive. These options are trading right around $1.94, $194 per contract. It's more expensive, but you get what you pay for. You're getting a higher quality position. That far out of the money call option that we looked at with the weekly cycle, there was an 85% chance of that option closing out of the money at expiration, meaning you have a very low probability of success. Now that I go slightly in the money, now I'm starting to stack some odds in my favor. Right now I start to see, over a 60% chance of that option closing in the money. I'm paying up for that option, giving me a higher quality position. Now I don't need to see everything line up perfectly. Going out 40 days, the time decay is not as significant. I get a higher quality position that gives me the ability to hold the trade longer if the trade just takes longer to complete. Just because it has 40 days left to expiration does not mean I need to hold for 40 days. I've had positions on here recently where I open the position with 40 days left to expiration and I'm in and out in 3-4 days and I'm booking a 50 to 100% return. Right? So give yourself that time. Don't just swing for the fences going for the shorter term weeklies. I'm not saying it's a bad approach with everything that you got. Right? What I'm saying is let's mix it up a little bit. Right? Let's take some short-term trades. Let's take some swing trades. Let's implement some more layers of diversification into your trading. So here on this one, I also take a look at the volume and open interest. You'll see the volume, 864 of those contracts have traded so far today. 28,000 contracts of open interest. It's very liquid. My rule of thumb, I look at open interest, and ideally, I want to see open interest 30 times the number of contracts I'm looking to trade. If you're just looking to come in and buy an individual contract, look for 30 contracts of open interest. If you're trading 10 contracts, look for 300 contracts of open interest. The more liquidity, the tighter the markets, the easier it's going to be for you to get in and out quickly and at good pricing. If I put this position on, if I go back over to my chart, I know where my targets are at up above. I know where my stop is at down below. Now everything's mapped out for me. I'm not left guessing whether the market's going to head higher or lower. If I see some movement back and forth, I'm not going to overreact. I'm not overly concerned because I know that roadmap is in place for me. Right? Plan your trade and trade your plan. Very, very crucial long term. It's a missing piece for a lot of retail traders. And again, if we're dead wrong, we're in a fully risk-defined trade. If those options, if we buy them for $1.95, the most I can lose is $195 per contract. I can manage my risk well. I'm not going to throw my entire account at this one trade. We recommend risking between 2 and 5% of your account per trade. That way, if you do have a losing trade, it's inevitable. It's going to happen. It's part of trading. It's not going to leave you in a large drawdown. It's not going to wipe you out. Trade small. In this market, as volatility is picking up, you really want to make sure that you're positioning yourself for long-term success. You never want to be in that situation where the outcome of one trade impacts your ability to take the next trade. So keep the risk small. Get that plan in place before you ever put your capital on the line into a trade. Make sure you have an entry, target, stop levels outlined, and make sure you're putting on a position that matches your outlook. If I'm looking for a swing trade, I'm going to go out 40 days. I'm going to go slightly in the money on the options that I'm trading. And I'm going to make sure that there's enough liquidity there where I can get in and out quickly and at good pricing. If you can follow those steps, you are going to be far ahead of so many other retail traders. And what I just outlined for you is based off of my years of working with traders. So if you have any questions on this specific trade, feel free to post a comment on the video. More than willing to help out with any future questions. And make sure you hit the like and subscribe button. That really helps our channel so we can get you more content like this here going forward. So I'm going to wrap this video up here. I'll be back with you guys shortly with our next video.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.